Good morning and hello, or good afternoon for some of you. Welcome to this month's webcast, the FASB project on nonprofit financial reporting. Today we have in-house with us, we have Sibi and John from Marks Paneth. Today's webinar is brought to you by 501c Agencies Trust, the nation's oldest unemployment program. If you're a 501c3 and have more than 15 full-time employees, it'd probably be to your benefit to contact 501c Agencies Trust to see if they can help you with your unemployment costs. A number of you are already working with 501c Agencies Trust, and we really do appreciate your membership in our organization. As usual, we have a couple of housekeeping items this morning. As you can notice by my hesitation a little bit, for those of you who have joined us in the past, we are using a brand new webinar application this morning. We've moved to GoToWebinar. Our little monthly program in here has gotten big enough that we had to move to a different system. We have probably about 400 or 500 people registered for today's session. So our program has gone well, and we've had to move to a different application. So I'm going to walk you through it real quick. As you can see, the slides are right there in front of you. On the right-hand margin, you have the question area, which is the question bubble. Type in there for any questions you might have. This session is being recorded. As you can see, there's a recording area at the bottom. We also have handouts right below the question bubble. There's a little piece of paper icon that has a PDF of today's slides. So you can go ahead and take those with you. As Mark and Sibi go through this, you can follow along at your desk if you want to, or save those for a later date. Also, today's session is being recorded. About 60 minutes after this session is over, you'll get an email from me with a copy of the recording, so you can watch it again or hand it out to colleagues, whatever you need. Today's session is also worth CPE. You're going to need to stay on the session for the entire hour in order to get those credits. Those are being provided by Marks Paneth, so please stay on so you can get those credits later in the day. Or it'll take them about a week, I'm sorry. Take them about a week to get those to you, so please be patient. If you have any questions, you know my email. You can email me back. This is the time I'm going to go ahead and introduce Sibi and John. Sibi is a partner within the nonprofit and government group at Marks Paneth. He's got 12 years of experience accounting, auditing, tax, and consultation with the nonprofit sector. So he knows his stuff. Also with us today is John. He's a director at the same organization, Marks Paneth, and he has over 20 years of experience with audit, accounting, and consulting services, also within the nonprofit sector. He also does some government work, but we won't hold that against him. Good morning, gentlemen. How are you all doing today?
Good morning.
Good morning.
So I'm going to go ahead and hand this off to Sibi, and sir, you have control of the slides, so please feel free to. Oh, you did have control of the slides. Sorry about that. See, I did preface it that this is a new system because I might mess it up here. Hang on.
Okay, you got a nice screensaver there.
I know. Thank goodness it was of the family. The other one's of the dog. Okay, we're back up. All right, Sid, you should have control now.
Okay, let me just test this. Okay. All right. Welcome everyone to the webcast. This is Sibi Thomas. We have a national audience here, so good morning, good afternoon, good evening, wherever you are. Our agenda for today is to go over the new FASB financial reporting standards for nonprofits, and also to look at why FASB made these changes. And we will also give you some implementation tips as to how the implementation will look like once you adopt the new standards, and followed by approximately 15 minutes of Q&A. I'm just trying to go to the next slide here. All right. So, John and I recently did a live workshop on this topic along with Rick Cole from FASB, which lasted about 3 hours. So today we have an hour, so I'm going straight into the subject here. For the 3-hour session, I had some jokes written up and all that, which I'm not going to get into today, so it's going to be all pure subject matter. So on August 18, 2016, FASB issued a final standard that affects all nonprofits issuing their financials on a GAAP basis. This is the biggest change since the 1990s, and the topic is Accounting Standards Update 2016-14, topic 958, if you want to know the section where it is. The new standard really simplifies and improves how a nonprofit classifies its net assets, its liquidity and financial performance, cash flows, how it reports its expenses. So one thing when I started looking at this new FASB standard is, you have the current financial reporting model that is held very well for the last 20 years. So why did FASB issue the new standard? My take on this was there were concerns, or there were voiced concerns from the stakeholders like the government agencies, the donors, the banks, the board members, on really understanding the complexity of the current net asset classification. And also there is a lack of reporting on the organizational liquidity in the current model. So I think the FASB what tried to achieve here, and I think they did a very good job on that, is to set a new standard that improves the net asset classification and also provide more transparency on the organization's liquidity. Okay. Technological difficulties. Try to move to the next slide. Okay, it's good. So the whole FASB project was divided into 2 phases. The phase 1 was issued on August 18, which is what we're going to cover today. The phase 1 impacted the following areas: your net asset classification, reporting of investment activities, liquidity and availability disclosures on the financials, expense reporting, and cash flow statements. The second phase, which is still in the discussion stage and there is no date set as to when this is going to be finalized, or if it is going to be finalized, we don't know, but the second phase is really to address the requirement or a definition for a measure of operations on your statement of activities, realignment of the certain line items on a statement of cash flows, and also think about something called segment reporting. So with that said, we're going to go in depth into the phase 1, which is what is applicable to us now. Still trying to move the slide. Okay. Takes a while after I press the button to actually get to the next slide. Okay, the first item that I'm going to cover is the net asset classifications. The net asset classification currently is 3 sections, the unrestricted, temporarily restricted, and permanently restricted. The current net asset classification of unrestricted net assets is renamed to without donor restrictions. And the temporarily and permanently restricted net assets are combined and renamed to with donor restrictions. It is important to note here the new net asset classification focuses on the word donor, which was always the case even with the old classification, but it was never clear. Now it is very clear as to the restrictions are imposed by the donor. So you have 2 classes now, which is without donor restrictions and with donor restrictions. The second item within the net asset classification section, the major change is something referred to as underwater endowment funds. So when you have endowment funds, which is permanently restricted or any donor restricted endowment funds, and if the fair value of the donor restricted endowment funds are below the original gift value, that portion that it is below the original gift value is referred to as underwater endowments. Currently, in your financial statement, the underwater portion of an endowment fund is classified or grouped under unrestricted net assets, or in our new term, without donor restrictions. But with the new standards, the underwater portion of endowment funds are classified under with donor restrictions. So it stays within its class. Before, the underwater portion was moved to the unrestricted piece. Now it stays with donor restrictions. And that is a major improvement when you consider, because under the new standards, the note disclosures should reflect the amount required to be maintained by the donor, and also the fair value of that fund as of the financial statement date, and also should include the organization's spending policy, which raises the question as to whether the organization continues to spend or reduce spending on those underwater funds. And that becomes very clear in the notes with the new standards. Board-designated funds. This is also one area that was considered to be a major improvement. Even though many organizations already disclose or report board-designated funds in their financial statements, it was not a requirement specifically. But with the new standard, the requirement is you have to either disclose in the notes or on the face of the financial statements the amount of the board-designated funds and also the nature of the designation. And John will go over this later. One of the things we advise our clients is you have to focus on the accounting implications before board creates a board-designated fund. Because board-designated fund, there is a perception among board members or in general that if you have a large endowment portfolio or investment portfolio, you could consider and take that and put it into a designated bucket. But now there are some disclosure requirements on liquidity and availability, which John will cover later. Now you have to consider the implication on those disclosures once you create a board-designated funds. I'm having technical difficulties on moving the slide here. Hold on one second. Mac, you want to give it a try? Okay, so I was able to move that. That's good. The next item under the net asset section is expiration of capital restrictions. So this is important because historically an organization was able to imply time restriction on donated property. So if you received a donated building and the donor did not have any explicit restrictions on those donated building, organizations have taken the position that, we are going to amortize this building and depreciate this building over next 20 years. So we're going to park this as temporarily restricted and release it over 20 years as we depreciate the building. With the new standards, you cannot do that. So the implied restriction goes away. So with the new standard, unless the donor have explicitly said that implied time or purpose restriction on the donated property, you have to recognize that as part of unrestricted net assets, or in the new term, without donor restrictions. And one other thing to highlight is currently, if you have these type of implied restrictions in your net asset portfolio, you have to release them and move them to unrestricted or without donor restrictions as you adopt the new standards. So net asset classes, what was FASB thinking on these changes on the net asset classification? The term unrestricted net assets was often confusing to non-accountants, which gave a notion that such net assets are truly available for operations. Oftentimes, this is not the case, since there could be contractual restrictions on those funds by governmental funding sources, or even board designations for a specific project. The new name, without donor restrictions, provides more clarity, and combining the temporarily and permanently restricted net assets into a new category of with donor restrictions make it much easier to understand. In addition to that, if you're familiar with the Uniform Prudent Management of Institutional Funds Act, often referred to as UPMIFA, permits the organization to keep on spending even if the funds are underwater. Thus, it makes perfect sense, really, for the underwater portion to be included within the donor restricted net assets. Remember, the calculation of the donor restricted net asset is exactly the same as the current model, which is on a fund-by-fund basis, so it really doesn't change anything. It's really the presentation that changes in this section. So the practical implementation, let's look at how this is going to look at in your financial statements. The two minimum categories, which is with donor restriction and without donor restriction, are the two minimum requirements. But I totally encourage my clients and organizations to really give it a thought. If you feel that the users of your financials want to see more detail, you can disaggregate the two minimum categories into more detail, either on the face of the financials or in the notes. If an organization decides to disaggregate the two minimum categories into more lines on the face, you still need to present the two minimum categories, the totals for the two minimum categories. You see an example in this slide. You could break out without donor restrictions into multiple lines. For example, one of the things, if you have a lot of plant, property, and equipment, out your investment in property and equipment. If you have defined benefit pension plan, you could break out the effect on the DB plan in this piece and really show what is truly available for operations. So that is, if you choose to do that, you still need the subtotal of the two minimum categories that is required. So I encourage the organizations to start looking at your existing net asset classification and see what funds are rolled up into each net asset category. A detailed mapping exercise of what makes up each section would really help when you start thinking about implementing the new standards. And organizations can be creative as to what you want to name each line. They can choose to disaggregate further. One other option is to add more columns on your statement of activities, which I feel like will add more confusion, but there are different ways to present this, your current net asset portfolio. So there are flexibilities as to how you present it. With that said, I'm going to give this to John now to take us through the rest of the topics. John?
Good. Good afternoon, everyone. As Sibi said, it's John D'Amico. I'm a director here at Marks Paneth, and I will be taking you through the rest of the seminar. The next area of change that the FASB ASU has implemented is the reporting on investment return. Currently, we for investment return, we're allowed to net just the external management fees. To our investment return and show a net number. That's basically one of the only few net numbers that we can show on the financial statements. But now the new ASU is requiring that we net also all the external and direct internal expenses. That has to be determined and netted against the investment income. Okay, so then. That's basically some of the other external things that's mentioned in the ASU is also including not just the management fees, but it's also including the embedded fees in mutual funds. That would have to be determined and broken out. On the direct internal expenses, that would be basically the salaries and benefits of of the persons that are involved in managing your investment portfolio. Could be the CFO, the executive director, or the chief investment officer, if you have one. Those expenses would be and has to be netted against your investment return. Okay. Also, in the ASU, in the Accounting Standard Update, the disclosure of the investment expenses will no longer be required. That is not to say that you can still disclose that if need be, but it's not going to be required disclosure. Currently, you would have to disclose what the investment expense is. Also, no longer required would be the disclosure of the investment return components. If it's your interest, your dividends, your unrealized and realized gains, that disclosure will no longer be required. But again, if you, as the owners of your financial statements, feel that you want that in there, that is perfectly okay. Okay. And of course, you'll still need that information for your 990 going forward, but will no longer be needed in your reporting in your financial statements. Okay. So the next area I will be covering is a bigger area that FASB felt very strongly about, is about liquidity and availability of funds. That has been a big focus on FASB's not-for-profit project, because like a not-for-profit, like for-profits, not-for-profits need to be liquid and be able to pay their bills on time when they need to pay their bills. So they basically they stated that the reason for this thinking on their part was there was very limited disclosures required, if any. Basically, currently, non-for-profits should be reporting their assets and liabilities sequenced on the statement of financial position in order of liquidity, but there's really no disclosures on how they manage their funds and how they would have available funds to pay their current obligations when they're due. So that was a big focus on that. When the proposed ASU came out, there was a lot of feedback on that, and as it says there, the feedback was mixed. There was a lot of people for and a lot of people against it, so they really had big issues in this area of how they should move forward. But basically, as it says there, during the redeliberations, they aim to separate the two liquidity and availability into two separate objectives, and to have an objectives for them. So for liquidity, they would want a qualitative disclosure of liquidity risk and how that's managed, and also disclosures on the objective on availability, which will draw from information on the balance sheet or your statement of financial position using quantitative and, if necessary, qualitative disclosures. So that is what they were thinking and how this came about. And I feel personally that's a good thing. Not-for-profits really need to, maybe better disclose on their liquidity, on their viability. So the ASU, that when it came out, was requiring enhanced disclosures on this information. They feel which would improve the disclosure usefulness of information, helpful in assessing the following. I'm going to not read all of these to you, but clearly the first couple of them are very important. The effects that limit the use of resources. That could be, your board-designated funds, your temporary and permanently restricted. Those assets are on your balance sheet, but those limit those resources. Those cannot be used for current obligations. The methods, you have to disclose the methods by which a non-for-profit manages liquidity to meet near-term demands, and the types of resources used and how they are allocated in carrying out the not-for-profit's operating activities. So to be more disclosures on that, and I will show you some in the next slide or two. So they basically, what FASB approved in this ASU is, as I just mentioned, two objectives that need to be dealt with in the financial statements: qualitative information and quantitative information. Again, qualitative is how a non-for-profit manages its liquid resources and its liquidity risk. That should be in the notes to the financials. Also, the quantitative information, it communicates the availability of a non-for-profit's financial assets at the balance sheet date to meet cash needs for general expenditures. That's key there, general expenditures within 1 year. Also, it says on the face or in the notes, but I clearly believe that should be in the notes. On the next slide, basically has information that would be needed on liquidity and availability. Information on there says a classified balance sheet is a good starting point, something that I believe here we feel a little bit strongly about. That's a very good way of showing classified balance sheets, showing all your current assets, current liabilities. Is a good start on what is within 1 year, because that's what the requirement is. But even without a classified balance sheet, that's not required. Without that, you would have to have, if you did do that, proper labeling of those, segregation of assets has to be separated out. But the problem with a classified balance sheet, that also includes non-financial assets, which really kind of not exactly what FASB was hoping to get at, and that's why they didn't require that. But that was being contemplated to have a classified balance sheet. But what they did come up with and what they did approve was a quantitative disclosure that can be provided in the chart form there, as you see on your slide, starting with the financial assets at year end. That's your cash and short-term investments, and basically backing out items that are not available to meet current operations within the year. Those are restricted by donor, time or purpose restricted, that can't be used for general obligations, subject to appropriation and satisfaction of donor restrictions. Investments held in an annuity trust is not available. Also, quasi-endowment funds are not available for long-term investing, so that would all have to be backed out. And any, as was mentioned, board-designated funds would also have to be backed out. And you might be saying, well, board-designated could be undesignated, but if they've been designated as of that balance sheet date, and it's not for general operations, it's designated for property, plant, and equipment, that would have to be backed out. So that's including board-designated funds, and this kind of note would be required going forward. What is available, and as you can see from this example of 234,000 that they had in financial assets, only 5,000 would be available for general expenditures. That's a very clearer picture of how they can meet their general obligations. All right, so that's basically the part on liquidity and availability. Basically, it'll be more disclosures, how you manage your liquidity risk, and a disclosure on your financial assets at year end, as of your balance sheet date. Next area is on the cash flow statement. Good. Good. Cash flow statement is another area that FASB had very strong opinions on. Currently, we're allowed, not-for-profits are allowed to do a direct method or an indirect method. There was very strong push to have not-for-profits all use the direct method. That kind of didn't happen, but that was contemplated very strongly. And even while they were voting on this, there was members of the FASB board who actually, made sure they got their vote in that they wanted a direct cash flow method, but it was not approved. So basically what's happening is that they believe that the direct method was way more useful and that the indirect method was not understood, not easy to follow, and no one basically even used the statement. The FASB felt that having a direct method would be much more useful for decision users to make. I personally am not too, I wasn't believing what they said about the direct method. I believe the indirect method is a useful statement also. I know banks use that when they're determining the viability of any entity. The cash flow statement is useful information. The cash generated from operations to pay down their debt from a bank's point of view is very useful. I know board members also find it very useful that they're generating cash, even on the indirect method, from operations to cover their investment activity and their debt. So I wasn't me personally, too keen on just going with the direct method. I understand the benefits of it, but I thought indirect would be fine, and basically that's what they allow. They're still allowing the free choice between the direct method and indirect method in the operating cash flows, and still to encourage the direct method, the FASB ASU has eliminated the indirect reconciliation. It's no longer required if you use the direct method. So if you're using the direct method, please go on, keep doing that. That's perfectly allowed. The part at the end of the cash flow statement where you're doing the reconciliation to the indirect method, that reconciliation will not be required. But again, I would believe if you want it still there, you can still have it, but it won't be required. Okay? So FASB's thinking on this is they think free choice is a good first step, but they really do feel very strongly about the direct method. As it says right there, they felt very strongly that it's more useful and easy to understand. So that might happen one day, but not now. And I don't believe that's even slated in the phase 2 of this project. So right now we're fine. If you use the indirect method, you can keep going using the indirect method. But it was a really strong push to have that change. As it says there, public universities that adopted the direct method on the GASB found that it was much more useful. This was basically part of their argument that they found it to be more useful. And I believe now GASB institutes still have to follow the direct method. This has nothing to do with the GASB pronouncements. These are under FASB. Okay. The next area was also a very large area that they tried tackling was the expense reporting. They felt that the expense reporting by non-for-profits needed to be a little bit updated. They felt that this is an area that needed to be revised since the ASU, the original accounting standards, came back out in the mid-90s. They felt this was an area that needed a lot more, some changes in there. Currently, right now, all non-for-profits have to report their expenses by function, right? We know that. They have to report by their program, their management in general, and their fundraising. There was no requirement to report by natural classification, which is, the salaries, benefits, rent, depreciation, those type expenses. Like I said, all non-for-profits had to report by function. So now they felt that wasn't too clear, and actually, I attended some of the FASB's deliberations on this and actually heard that they were actually thinking of, it actually came up once, of not reporting by function anymore, and purely to report by natural classification. I was very shocked to hear that, and of course that quickly got shot down by the FASB staff in the room that said, no, that was never part of their thinking to go away from reporting by function. Not-for-profits are judged by how much of their expenses are program related and how much is admin, management in general. So that is not going to happen. But there was actually been deliberated. So the ASU that came out will now require all non-for-profits to provide in one location, that's a very key word there, that's why it's underlined, a disclosure of all expenses by natural classification and by function. Presently, only voluntary health and welfare organizations had to do this. Now it's every non-for-profit will have to have in one place. That place can be in a statement, it could be in the notes, or literally right on the statement itself, like on your statement of activities, a separate statement like a statement of functional expenses, but it has to be in one place that has all your natural classifications, your salary, rent, depreciation, consultants, whatever natural classification, and by function. That's all the colleges, the membership organizations, every non-for-profit will have to report by natural and by function. All right? As I said, it could be on the face. You'll see some examples of that. But the key word there, it has to be in one location. Currently, I know of some non-for-profits that report on their statement of activities their expenses by natural classification, which is allowed as long as they have a footnote that spells out and has the totals of their program, managing general, and fundraising. But on their statement of activities, it's by natural classification. That will no longer be allowed, because as I said there, it has to be in one location. That's not one location. So if you're a non-for-profit that does report your expenses by natural and has a footnote explaining and totaling up to by function, you would have to change that. You would have to have the full note of what information is. We basically have been telling our non-for-profits that we deal with that don't have this, because remember, currently only voluntary health and welfare organizations have that statement, is to actually start doing one, which is really probably not that hard for non-for-profits because they have to have that analysis anyway for their 990. So the having that statement would be like a required statement now. The funny thing, if you were a voluntary health and welfare that had that statement, well, now you don't need to have that statement anymore. That's pretty funny, because now they can go like all the others. You can have it in a note or right on the face of the statement of activities. You don't need that separate statement. So they didn't exclude them in there. But since they're already doing it, I would recommend any voluntary health and welfare organizations that are on this call with us today to keep doing it. That is what all non-for-profits would have to do. It makes it much simpler. Okay. Let's see. The ASU also requires, to the next slide. Good. Now we're good. Thank you. Well, we're having little technical difficulties. 1 second. It's a little bit hard on our end to change the slides for some reason, so please bear with us. There we go. Thank you. The ASU that came out will also require to provide qualitative disclosures about the methods used to allocate costs among the program and support functions. That is something that's new, that's not been required before. In the past, a lot of non-for-profits, currently, not just in the past, currently non-for-profits will have maybe a simple accounting policy that costs are allocated among program and fundraising, based on management's estimates or some other method. Now you would need a little bit more disclosure than that. You would need clearly if expenses are allocated based on FTEs or square footage. You would need a little bit more information than what you're currently doing. That's required. They really feel strong about how costs are allocated amongst the different functions. And they also mentioned in the ASU they want enhanced guidance. They have an enhanced guidance on allocations from management and general expenses, basically into program. There's the concept: is there direct conduct or direct supervision? So in the ASU, which really can't go into all this at this moment, but in the ASU there is more guidance on how expenses that are allocated amongst management and general expenses should be done going forward. Okay. So what was FASB thinking on this? Maybe we can get the slides moved, but we're getting there. It's just a little bit slow on our end. It's not, the presentation is not literally on our servers or on our laptop here. I believe it's more general. That's why it's a little bit slower.
Presentation is moving.
Good. Okay. Thank you. So so what was FASB thinking about all this? By having us report, non-for-profits report expenses by natural classification, they felt it provided a lot more information about the stewardship and resources and both the fixed and variable costs. You can easily see that on a statement of functional expenses where the money is being spent. In the past you couldn't tell if it was salary related, was it consultants, or what was really being spent if it was purely being reported by function and by program. So you would know what the program and total program expenses. You couldn't see, of course, there's no way of seeing on the statement, the financial statements, of what that components were. But of course, if you got a hold of the non-for-profits 990, then it's clearly broken out there. But they felt it should be broken out in the financial statements also. So now we can easily see what the program, what's the components of program and M&G and fundraising. So that's why that got kind of passed. There was concerns in their outreach message on this, whether that analysis was sufficiently relevant and cost-effective for certain healthcare-related entities and certain other business-like non-for-profits. There was actually a lot of pushback in doing it that way, but they went ahead and approved it. So basically, all non-for-profits do have to report their expenses by natural classification and by function. As it says there, for those healthcare-type entities and those business-like non-for-profits, they might explore going forward segment reporting for them as an alternative in phase 2. So, but at the moment, I believe, and I'm positive, that all non-for-profits will have to report by natural and by function. Okay. On the next slide, as a typical example of a statement of functional expenses, by the time maybe when we get there, it'll come up. But good, it is there now. Thank you. The top box there is a good example of what a voluntary health and welfare organization prepares and has it as one of their required statements. The statement of financial position, statement of activities, and the statement of functional expenses. If you're not a voluntary health and welfare, you didn't have to have this. I know a lot of non-for-profits who even really weren't fitting the definition for a voluntary health and welfare had a statement like this. Again, personally, I feel personally that this is a very good statement to have. And I also know that some non-for-profits, who, even though it wasn't required, would have it as a supplemental information. And since now that it's required, basically if you have it as a supplemental information, you can no longer keep it as a supplemental schedule. You would have to have it as part of your other exhibits, your balance sheet, income statement, your statement of activities, and your cash flow. That would be required. But again, it's not required to have it as a separate statement. You can have this in the notes. You can have this whole information in a footnote. Okay? It could be a pretty wide footnote if you see you have multiple programs. I personally would recommend it that you do have it as a statement. Okay? The other option is literally to have it on the face of the statement of activities. That is the second box on your slide. Your grant activities is your program. So then you would need the breakout of what's being charged to that program, your salaries, your occupancy, your depreciation, all your expenses that are going to be charged to that program would have to be listed out, but at least with a total. I've seen non-for-profits do it this way that are usually a little bit on the smaller side, or it doesn't have a lot of different type expenses, so it really doesn't take up a lot of room. But as you can see, those same expenses that are now charged to management general, and if you had fundraising, you would need another whole set. So that could be a very long statement of activities if you do it in this approach. You would have all your revenues, and then you would break out every expense item by its at least three different functions, and then a total, getting down to your total expenses. Again, if you have a lot of different line items, different type of expenses, that would make a very long statement of activities. So I think the easiest way to have it as a separate statement or in the notes. Okay? On the next slide is what I mentioned earlier before about providing enhanced disclosures. They really do want, the FASB ASU really wants to make sure that it's being communicated in your financial statements, how costs are being allocated. And there will be examples on that in the ASU to be done. But basically, you would need a better enhanced disclosure in your accounting policies of how costs are being allocated between the functions. Okay. Also, the FASB's ASU also is refining the definition of what's management in general. And they're providing implementation guidance to better depict the types of costs that can be allocated among program and support functions and those that should not be allocated. certain things are management in general, other things aren't. So they felt very strongly to have it more consistent. I believe that there was inconsistency between what people would consider management in general and program. The attempt here is to try to make that a little more standardized so that it could be easily be compared to one non-for-profit to another, basically. And everybody knows exactly what's management general and what's program related. And as you all know on this call, that non-for-profits are judged a lot by how much of their money, their expenses are program related and how much aren't. So that is what FASB is trying to help make sure that is more standardized. Okay. So basically, that is the end of the changes of what is going to be required going forward. The next slides I will be talking about is when is all this going to happen. Okay. So the effective dates, as it says there, is for fiscal years beginning after 12/15/2017. That's basically your 12/31/18 year ends. If you're a calendar year, you would have to implement this by 12/31/18. If you're a fiscal year, such as a June 30th, that will be June 30th, 2019. So if you're a non-for-profit here in the New York area, a lot of our non-for-profits are June related, they will have to have it implemented. They would have to do this new reporting standards by their June 30th, 19. Of course, in the ASU, they're allowed early adoption. They really feel strongly that this is something that could be done, as of now. They want this done as of now. So they're allowing early adoption, and if you early adopt it, basically you have to apply all these what they call regular transition provisions. That is, for the years of adoption, if it's the effective date or early implementation, you apply all the provisions. Every single one of them would have to be adopted. For the year, but for the years, that's for the years presented, but for some comparative years, a lot of this information was not required in comparative years. So for comparison years, they're allowing you to apply only the provisions, except you can choose not to present analysis of expense by nature and function for that's for the comparative year, the prior year, or or the disclosures around liquidity and availability for the prior year. I can understand that one because you did it for your current year, you implemented. To go back about that information is really not even that relevant because that year is gone. So I would, if you're implementing this early, the analysis by expense by function for both years would make sense, especially if you're already doing that. You can see your comparison from year to year if that's what you choose to disclose. But the disclosure about liquidity for the prior year, since they're not requiring it in that year, I personally would, not waste the time and effort to figure that out for the prior year that's already passed. Okay, basically that's the kind of the end of our presentation. I hope that this has been helpful and informative, and we will have question and answers, and for the next few minutes or so, for a while.
Before we go into the Q&A, just a couple of things. Our information is included in the presentation package,
Yep.
Which you will be receiving. So if you have any questions on any specific topic, please feel free to email us or call us.
Email is good because our emails are on there.
Yeah, our emails are on there.
On our bio slides is right at the beginning.
And also, talking to a lot of nonprofits, one of the questions that I always get is, which part of this standard is the most difficult to implement? And talking to the CFOs and controllers in the nonprofit in the New York area, one of the biggest challenges they think is the liquidity and availability disclosures, because many of them don't present a classified balance sheet at this point, but to really look at the assets and really consider what is truly available for general operating purpose. So So the disclosure is both qualitative and quantitative. So many CFOs and controllers feel like, that is probably the most difficult area to adopt, especially if we have government grants. You could have liquid cash in the bank, but it could have some regulatory restrictions on it as to which programs you can use it for, or even some bond sinking fund arrangement. You could have assets which are not really available. So that is one area that we have heard from many of our clients that they feel like is the most difficult to adopt.
Yes.
With that said, I'll turn it over to Mac, who's going to go over the Q&A.
All right, thank you guys. And just to reiterate what they were saying, a copy of the slides is available on your screen now. If you go under attachments, you can pull that. And you'll also get a copy of the session today emailed to you approximately 60 minutes after we're done. So we do have a couple of questions. If you have any questions, please feel free to start shooting them in now, and we'll get to as many as we can. Guys, you can open your Q&A area too on your screen, so you can follow me along as I go through these. First question, okay. If a non-for-profit receives contribution for the construction of a new building, we are now required to release those funds either as the building ID being built or once it's put into service, not as it's appreciated, correct?
Yeah, I'll take that question since I covered that area. So if you receive contribution to build a new building, so the new approach is placed in service approach. So you will put that as an asset when you place that building into service.
Without donor restrictions.
Without donor restrictions. So if the donor did not explicitly put a purpose or time restriction on this donation, it is an unrestricted contribution. So yes, you will have your depreciation expense over 20 or 25 years, which don't have a equivalent revenue to match because you picked up all the revenue the first year. So the key is, if you feel like, okay, I want to restrict this for the next 20 years, the best way to approach that is to get that explicitly in the donor letter. If you don't have that in the donor letter, and if they are just giving you monies to construct a building, once you construct the building and place in service, it is unrestricted contribution.
Without donor restriction.
Without donor restriction in the new net asset category.
Okay. Hopefully that answered the question.
Yeah, if you have follow-up questions, just feel free to.
Okay, I'm going to move down to, here's a technical question. Anybody using QuickBooks? Has the software been updated? Do we know that, guys?
Probably not yet. I never heard of that, but I would bet anything that they were definitely going to start changing it for that kind of verbiage change that that you can make it clearer going forward. But I'm not aware of that.
Yeah. So one thing important here is this is really a reporting change. The accounting for nonprofit have not changed. This is how you report financial statements. So your chart of accounts needs to change. You cannot call it unrestricted net assets anymore because the names have changed. So on the QuickBooks side, to that specific question, I really don't have the answer to that because most of my clients don't use QuickBooks. But that's something I would reach out to them to see, have they even thought about this?
Right. That's a good advice, Sylvia. Reach out to QuickBooks and see when they're going to be updating their software. Because I know in QuickBooks you can print out sample financial statements, and it should be in the right format now. Yes, and have information about these things that we talked today kind of built into it. That'd be great. If not, I would recommend they be looking into maybe a better software. If not, right? Right? That's good. If they're preparing their own financial statements, that's very good. Have the right tools to get you where you need to get to.
So next question, going back to unrestricted and restricted net asset definition. You guys talked about donor restricted. Are there any more examples? What about grants, government properties? What about those?
I can talk about that if you want. Or, grants, could be the difference. Is it really an exchange transaction, especially from governments? It's usually an exchange transaction. The government is really not in the business of making contributions. So remember, a donor can only restrict their contribution. A grant, it could be the word grant is where it could be misleading. There'd be grants that are basically a contribution where the non-for-profit really doesn't have to do anything except maybe give them a report at the end of the period. That it could be considered contribution, and then it could be subject to the donor or non-donor. Let's say it was a large foundation gave a non-for-profit money to help run their program. If there really isn't anything specific in that grant that they had to do to accomplish that will benefit the provider, then it's a contribution.
So there is no change on the definition of contribution or exchange transaction
Yes.
or grant with this new ASU. Remember, it doesn't really change how you account for it. It only changes how you present it on your financial statement.
But that is a key and a good question from the person who raised it, because you now need to understand that you can only have, with donor restrictions, items that are contributions, because you can't restrict an exchange transaction. Once you've earned it, it's without donor restrictions.
That's correct. Yep.
So that's a very good point.
Excellent, great. Keep your questions coming, folks. We
still have plenty of time, right?
Yeah. How about any resources, quick reference guides about implementing guidance for management on these things, a table or something? We're looking for some assistance, some reference guides.
I believe what's out so far is just the accounting standard update. I haven't seen any other guidance from any of the providers of accounting literature yet, but I'm not up on that. Maybe Sibi, you might be.
Yeah, so right now there is an option to early adopt. So the industry generally, these new standards, the higher ed is the first ones to early adopt most of the time. So they have the technical resources. They are more sophisticated than an average nonprofit. So you will see some early adoption that's going to happen in the next year or so. And that is a good resource to see how the other nonprofits are reporting. There is an article, there are a couple of articles out there. There's one that I wrote for Accounting Today. So if you go to accountingtoday.com and type in my name, it should come up, or just new reporting for nonprofits, it should come up. But implementation guidance, the FASB standards is 270 pages, so I don't think you really want to go over that. But it's really the articles that's been written out there, and also the early adopters that's going to adopt. And plus, your auditors should be able to guide you to the proper resources or provide you with advice as to how to
present examples. Yes.
Yep.
Especially on the liquidity footnotes and things that are definitely new. I would hope that that is provided, that they can help. In the ASU, it does have some good examples too. So I would recommend that even some non-for-profits to download it. It's FASB Accounting Standards Update, number 2016. The updates are by year, and it's number 14. And so it's FASB's number 4 update on the codification, and ASU 2016-14.
Okay, guys, got a question. Is there a threshold for reporting investment cost against investment income?
I don't believe so. I don't believe there's anything in there about thresholds. Even if it's a minor amount, you would have to net it.
Yeah. So currently, one of the challenges with investment expenses is you only know those expenses that are reported in either the investment statement or an investment advisor that is charging you, oftentimes with mutual funds and other types of investments, there are fees associated which you don't even see it. So even though currently a lot of organizations are showing their investment expense which is required, it's really not complete because there are investment expenses that are already netted in the earnings.
It's embedded into the earnings. Yes.
It's embedded into the earnings. So this makes it much simpler. Now you only have to, report the net earnings. You don't have to go worry about the expenses.
You still need to know it.
You need, for the 990 purposes also, you still need to know it.
Yes. That could be a challenge.
So, one more question. We'll probably conclude on this one. So, one audience member said that you guys constantly talked about how nonprofits are judged by their function.
Yes.
Obviously, nonprofits would like to move away from that type of classification and towards a more natural classification. Do you know what nonprofits can do to kind of influence FASB into perhaps judging them in a better way?
Oh boy.
That is an excellent question. So what's going on in the industry now, even in a lot of agencies, social service agencies specifically in the industry, there's a concept called overhead myth. So, the government agencies have kind of capped how much overhead can go into the programs, so 10% or 15%. But we all know in the world that we operate in, overhead should not be a measure to judge how a nonprofit is accomplishing its mission. And there's a lot of talks about this within the industry, and it is a great point, and I think in the next phase 2 of when FASB starts the deliberations, this is one point. When FASB starts the deliberations of proposing a new standard, they set out comment letters, they give you time to respond and comment on it, and this is one area the capacity building organizations or the associations of nonprofits in that sector need to advocate us to
Yes.
give some flexibility. But again, FASB does not say that an organization should have a limited overhead versus the program or admin. So they really cannot change the perspective on the industry itself.
Right.
You still need to present it by functions. I think it is more the watchdog agencies that need to move away from rating nonprofits based on overhead, how much they spend. At the same time, I'm not advocating 40% overhead,
right.
but that should not be a measure to ensure that the organization is accompanying its mission. And again, it's really not up to FASB to
Right.
do it. And there is nothing in the standards right now that prohibits organizations from having a large overhead or a small overhead.
Those are, like should be said, those are outside agencies, especially like the Attorney General, the state Attorney Generals. That is something that is on their kind of looking at when they're looking at not-for-profits. So that's kind of out of FASB's realm, but it's more of your state's Attorney Generals and the watchdog agencies of how a not-for-profit is done. So I'm not sure that can be easily go away.
And the governmental funding sources too.
And the governmental too, of course.
All right, well, we'll get one more in here. Betty wants to get one more question in here, and she asks, how do we account for in-kind investment service in the new statements?
It's going to be the same way. In-kind would be recorded as a revenue and expense, and the expense is equivalent to the revenue, so that would be a direct, the direct internal expense. If it's in-kind from like a board member or something like that, then it would be included. That would have to be netted out. Okay,
great. Okay. Well, that concludes the webinar for today. I appreciate John and Sibi for being with us, and for all of you for being with us. Like I said, you'll get a follow-up email from us in about an hour. It'll have a copy of this presentation attached to it, as well as a link to our next webcast in November, right before the holidays begin. And we're going to be covering cybersecurity threats for the nonprofit sector. Guys, thanks for being with us today.
Thank you.
Thank you.